This video is about an interesting piece of financial regulation that governs mutual funds in India. Let us define the problem statement first. If you run a mutual fund, there are broadly two areas where things could go wrong. One possibility, of course, is that the investments themselves could lose value. Or you could also have a scenario where a significant number of investors could withdraw their money. When a large number of investors withdraw their money, the fund will need to sell the investments and use the proceeds of the sale to repay its investors. The fund will, however, run into trouble if it is unable to sell enough of the investments. This can happen if the investments are not sufficiently liquid in nature. This brings into focus something we will call the redemption risk, which refers to the possibility of investors withdrawing from the fund. In 2020, 6 funds in India run by Templeton had to shut down because investors tried to withdraw their money, but the fund could not return the money because they couldn't sell the investments they had made. You will find the link for this in the video description. This brings us to a rather important question. How do you measure this risk? Given a set of investors in a fund, how do you quantify the probability of investors withdrawing their money? If you need to pause the video and think for a few minutes, please do. If you need a bit of help, let us frame the question as follows. There are 2 funds, Fund A and Fund B. They are of the same size and have identical portfolios. Fund A has only 10 really large investors, while Fund B has 10,000 small investors. Which of these 2 funds do you think carries greater redemption risk? Do you get the drift? Large investors tend to be more reactive and more likely to withdraw their money at times of stress, unlike small investors who are unlikely to go through the hassle of withdrawing. SEBI put in place a regulation to address redemption risk in 2021. And it is loosely based on the above idea that it is the size of the investment that dictates the probability of that investor withdrawing. The link to the regulation can also be found in the video description. I refer you to Table 1 of the regulation. Before we close, here is an interesting piece of trivia. Templeton eventually returned the money from its 6 funds it had shut to its investors. Rather interestingly, Templeton returned more than what it thought it owed the investors. This is because the final expected payment was based on the valuations in 2020, when the fund shut. Subsequently, the value of the assets rose following the pandemic. It goes on to show that it is not sufficient for a fund to make high-quality investments. It also needs to take into account scenarios such as the one Templeton faced. More formally, it is not sufficient for a fund manager to manage the price risks in the portfolio. They also need to manage market liquidity risk and redemption risk. If you liked this video, please hit the like button and subscribe for more videos.